Build your dreams, live rich, and leave rich.
Welcome to Live Rich and Leave Rich by Krish. We're about to tackle a really big question today. Why do so many people, good, smart people, end up losing money trading stocks? Now, before we dive in, I gotta say the usual. This is purely for educational purposes. It is not investment advice. For a plan that's tailored just for you, you gotta talk with a licensed financial advisor.
So let's get right to it. This is the million-dollar question, isn't it? You see all these stories online, people making a killing in the market. But for so many others, the reality is just frustration and loss. So what's really going on here? Well, the answer might be a lot closer to home than you think.
And there it is. The real challenge isn't the complex charts or the breaking news that's flashing on your screen. So often, the biggest battle we face is right here, between our own two ears. Our own psychology, our emotions, our instincts. They can become our own worst enemy when money is on the line.
Okay, so let's dive into what I call the trader's trap. We're going to unpack these powerful and often invisible mental glitches, these behavioral biases that are kind of hardwired into all of us. And trust me, they can totally hijack our financial decisions, no matter how smart or informed we think we are.
First up is a huge one, overconfidence. You know that little voice in your head? The one that whispers, "Hey, you've got this. You can totally beat the market." Yeah, that's the one. And it's fueled by the flood of information we get online, which creates this illusion that we're experts and leads us to take on way too much risk.
And this isn't just a feeling. A study by FINRA found that a staggering 64% of investors believe they have a high level of investment knowledge. Now, we all know it's statistically impossible for almost 2/3 of people to be above average, right? It just shows you how deep this overconfidence thing really runs.
Next, we've got loss aversion. And this one is so powerful. It's the reason we cling to a losing stock, hoping and praying it'll bounce back, just so we don't have to face the pain of admitting we made a mistake. At the same time, it's why we sell our winners way too early, just to lock in a small gain and avoid the fear of it turning around.
And this right here explains everything. Decades of research have shown that the sting of losing money feels literally twice as bad as the pleasure of an equal gain. This massive emotional imbalance forces us into making completely irrational decisions that directly hurt our portfolios. And of course, there's the one we all know too well, especially today, herd mentality. We see a stock blowing up on social media, everyone's talking about it, and that FOMO, the fear of missing out, just kicks in. So we jump on the bandwagon without doing our own research, often buying at the very peak of a bubble or panic selling during a downturn just because everyone else is.
So when you put it all together, the overconfidence, the fear of losing, the FOMO, you create this absolutely destructive cycle. These traps push us to do the exact opposite of what we should. Buying high when things are hyped up and selling low when everyone is scared. It's a perfect recipe for failure.
But let's say you do manage to get your own psychology in check. That's only half the story. There's also the external battle, the market itself. And in this arena, let me be crystal clear. Relying on luck is not a strategy. It's a surefire way to get wiped out.
This lays out the difference perfectly. The amateur investor jumps on a trend and hopes for the best. It's a gamble. A seasoned investor, on the other hand, knows that consistent success isn't about luck. It's about deep, research-backed foresight, really understanding the business behind the stock ticker.
And that research, wow, it is a full-time job. You need to understand financial statements, analyze industry trends, monitor economic policies, track global events. The list just goes on and on. So let's be honest with ourselves. Can most of us really dedicate that level of effort, day in and day out? For the vast majority of us, the answer is no.
And the attempt to keep up with all of that comes at a huge cost. I'm not just talking about your bank account. The constant stress, the screen time, the emotional roller coaster, it can seriously drain your mental health, your time with family, and your overall peace of mind.
So, what about the so-called shortcuts? I get this question all the time. People ask about options and futures, thinking they're a faster way to get rich.
Well, here's the hard truth. These are highly leveraged tools. That means while your potential gains are magnified, so are your losses. You can literally lose more money than you even put in. For the average person, this isn't a strategy. It's a gamble, and it is just about the surest way to lose all your money in the long run.
Okay, so if going it alone is a minefield of psychological traps and requires a full-time commitment, what's the alternative? Let's explore a smarter, more disciplined approach to building your wealth. Let's talk about the professional's path.
This table breaks it down beautifully. With direct stocks, you're the CEO. You're the analyst. You're the risk manager. You have to do it all yourself. With mutual funds, you delegate that work to a professional. You get instant diversification across hundreds of different assets, which is incredibly difficult and expensive to do on your own, and it's all backed by a dedicated team of experts.
And this is what that professional management looks like. It's a rigorous, data-driven process. These teams spend their entire days analyzing company fundamentals, assessing global economic trends, and managing risk, all to build a portfolio that's designed to meet specific goals over the long term.
And that gets to the absolute heart of the matter. It's the difference between a disciplined process and an emotional reaction. A professional fund manager operates with a system designed to overcome the very emotional biases we've been talking about. They're making rational decisions, not reacting to panic and FOMO.
So, to sum it up, the benefits are really clear. You get professional expertise working for you, your risk is immediately spread out through diversification, you can start with a very small amount of money, and you can access your funds pretty easily. It's just a powerful tool for the long-term investor.
This all brings us to a bigger, more philosophical point, because investing isn't just about the numbers in your account, it's about what those numbers can actually do for your life. So, what's the ultimate goal here? To live rich means to live peacefully, free from that constant financial stress. And to leave rich means building a lasting legacy for your loved ones and the causes you care about.
Ultimately, your investment strategy should serve your life, not consume it. The goal is to find a path that aligns with your goals and gives you peace of mind. A path that works with your human nature, not one that constantly puts you at war with it.
So I'll leave you with this question. What's the biggest challenge you see in investing? Let me know in the comments below. And if you found this explainer helpful, please subscribe, like, and share. Live Rich and Leave Rich by Krish. Thanks for watching.